You think markets react to crises the way the headlines say? They don't. They don't panic at war, at bombs, at tankers blowing up in a strait thousands of miles away. They react to something quieter, something the crowd hasn't priced in yet. Most people are staring at numbers. Gold at $5,400, silver at $96. They see fear and assume buy now, sell later is the obvious play. But markets aren't emotional the way people are. They blink, shrug, and sometimes drop prices in the middle of what looks like chaos. Here's the twist. The first week of a shock is usually misleading. You might think that if gold fell while the world burned, the bull thesis is dead. It isn't. What matters isn't the spike or the dip. It's the underlying tension nobody's counting. The mechanics under the hood, the debt load, the central bank moves, the supply gaps. Those are what actually dictate outcomes. Not the spike, not the headlines. If you've been trained to look at war and panic and assume markets will follow, reset. You're looking at the surface when the currents are below. The real story is rarely obvious. And right now, in mid-March 2026, those currents are aligning in a way that almost nobody in the mainstream is noticing. On March 2nd, 2026, Operation Epic Fury was executed. U.S. and Israeli forces struck targets in Iran. The supreme leader of Iran, Khamenei, was reportedly killed. Within minutes of the first reports reaching London trading desks, precious metals responded sharply. Gold touched $5,419 per ounce, the highest level since January 30th. Silver reached $96.40 per ounce. Crude oil increased roughly 13% to $82 per barrel before global markets opened. By March 13th, 2026, the market landscape had shifted. Gold was trading at $5,085 per ounce and silver at $82.34. These levels were both lower than the prices before the initial shock. Oil remained elevated above $85 per barrel. The Strait of Hormuz, a critical global oil export route responsible for roughly 20% of global consumption, was reported closed by Iran's Revolutionary Guard, with more than 100 tankers halted and 2 ships attacked. From a financial market perspective, the U.S. 10-year Treasury yield increased 0.4% from a 4-month low on the morning of March 2nd, coinciding with the initial spike in gold. This movement reflected higher inflation expectations amid rising energy costs. Gold and silver prices subsequently declined over the next 2 weeks, a movement that corresponds to historical mechanics where rising bond yields can suppress precious metals in the short term. Forecast data from Wood Mackenzie indicates that if the Strait of Hormuz closure persists, oil could reach $100 per barrel. Goldman Sachs has estimated an $18 per barrel risk premium already priced in as of mid-March 2026. J.P. Morgan and Deutsche Bank have published forecasts for gold at year-end 2026. $6,300 and $6,000 per ounce, respectively, reflecting structural market conditions rather than short-term price fluctuations. This section is purely factual and establishes the timeline, price levels, and expert forecasts. The price movements in gold, silver, and oil over the past 2 weeks are more than numbers. They reflect structural forces interacting beneath the surface. When oil spiked on March 2nd, the immediate effect was straightforward. Higher energy costs increased inflation expectations. Bond markets responded accordingly. The U.S. 10-year Treasury yield rose by 0.4%, signaling that investors anticipated tighter monetary conditions. That yield increase mechanically reduces the attractiveness of non-yielding assets like gold and silver in the short term. The second-order effect is that gold and silver temporarily underperformed despite geopolitical turmoil. Retail investors who reacted to the headline spikes found themselves underwater, while the structural factors supporting metals remained unchanged. The closure of the Strait of Hormuz compounds the pressure. With 20% of global oil supply disrupted, ongoing high energy costs embed inflationary pressure into the system. This strengthens the long-term case for precious metals, even as short-term prices remain suppressed. Debt dynamics further amplify these effects. The United States is rolling over $9.2 trillion in federal debt this fiscal year, with annual interest payments exceeding $1 trillion. High rates cannot be maintained indefinitely without creating systemic stress. When bond yields eventually stabilize or decline, in response to debt service pressures, the suppression on gold and silver could reverse quickly. Industrial demand adds another layer of complexity, particularly for silver. Silver is both an investment and an industrial metal. Higher oil prices and economic uncertainty depress industrial activity, which temporarily weighs on silver demand. However, the longer-term structural supply deficit, driven by 6 consecutive years of declining COMEX inventory and export restrictions from China, remains intact. Finally, central bank purchasing behavior reinforces these dynamics. In 2025, central banks acquired 863 tons of gold. This steady accumulation does not immediately influence the short-term price, but sets the stage for structural growth. When short-term suppression mechanisms unwind, gold and silver prices will react to both the embedded inflation from oil shocks and the ongoing structural accumulation, creating a concentrated, rapid price response rather than gradual movements. This section explains why these price movements matter beyond the immediate headlines and establishes the chain reactions affecting investors, debt markets, and industrial demand. Looking back, the early 1970s offer instructive parallels. In October 1973, the OPEC oil embargo caused oil prices to quadruple, from $3 to $12 per barrel. Gold reacted immediately, spiking sharply, then pulling back and trading sideways for an extended period, while inflation built into the system. Retail investors who reacted to the initial spike often exited too early, missing the broader 2,300% gain over the following 9 years. The key lesson: initial market spikes often misrepresent structural outcomes. A similar dynamic occurred during the Iranian Revolution from 1979 to 1980. Crude oil surged over 110%, and gold climbed nearly 150%, representing the most significant 2-year percentage gain on record. Again, short-term reactions did not reflect the sustained structural move driven by inflationary pressures embedded in the monetary system. In March 2026, some conditions mirror those historical events. A major geopolitical shock, sharply higher oil prices, and market panic that initially pushed gold and silver higher before a short-term pullback. Central bank accumulation of gold, high U.S. debt levels, and structural supply deficits in silver echo the systemic pressures that drove multi-year bull markets in the past. Differences are also notable. Today, the debt load is larger, energy disruptions are global in scale, and industrial demand for metals is influenced by sectors, solar, EVs, AI, defense, that did not exist in the 1970s. Monetary policy tools are more sophisticated, yet global interconnectedness means shocks can propagate faster. Additionally, central banks have been actively purchasing gold in record quantities, creating a structural underpinning that has no exact historical precedent. The takeaway is not to forecast a precise outcome. History is a filter, not a crystal ball. The structural conditions that historically preceded large, sustained precious metals rallies, geopolitical shocks, inflation embedding, supply constraints, and central bank accumulation are present today. Short-term price behavior may diverge from structural reality, but understanding the historical patterns allows investors to differentiate noise from persistent market forces. If the current structural conditions, high oil prices, ongoing central bank accumulation, and persistent supply deficits in gold and silver remain intact, then precious metals could experience a rapid, concentrated rally. A short-term pullback in gold and silver may have already cleared speculative positions, creating an accumulation window. If U.S. Treasury yields stabilize or decline due to debt service pressures, then the suppression mechanism limiting prices will reverse. In this scenario, gold could reach forecasts published by J.P. Morgan, $6,300 per ounce, and Deutsche Bank, $6,000 per ounce, by the end of 2026. Silver could outperform gold, potentially moving toward $120 to $150, supported by structural supply deficits and industrial demand in solar, EVs, AI, and defense sectors. Base case: if oil prices remain elevated, but the U.S. Federal Reserve maintains cautious policy and bond yields fluctuate moderately, then short-term volatility may continue. Gold and silver may trade within a range, temporarily underperforming headline expectations, while structural pressures build beneath the surface. In this case, prices are likely to consolidate above current levels, $5,085 gold, $82 silver, without triggering an immediate sharp surge. Retail investors could see further minor pullbacks, but central bank accumulation and persistent supply deficits suggest that the longer-term trend remains intact. Structural targets of $6,000 to $6,300 for gold and $120 for silver could be realized, but the timing may stretch beyond mid-2026. Bear case: if central banks unexpectedly slow or pause gold purchases, or if a resolution of the Strait of Hormuz occurs sooner than expected, lowering oil prices sharply, then the immediate inflationary pressures could ease. In this scenario, bond yields may remain elevated or even rise further, prolonging the suppression mechanism. Gold and silver could experience an extended period of sideways or downward pressure in the short term. Industrial demand weakness for silver, combined with macroeconomic risk-off sentiment, could amplify this effect. While the structural thesis of supply deficits remains, the pace of the rally could be slower, requiring patience for the eventual structural breakout. Conditional thinking is key. Each outcome depends on interactions between monetary policy, debt dynamics, supply-demand imbalances, and geopolitical developments. None of these scenarios guarantees a price. They are probabilities based on observed structural and mechanical market factors. Understanding these possibilities allows investors to differentiate between transient volatility and long-term structural shifts. When analyzing precious metals, it's not about headlines or social media chatter. It's about the mechanics beneath the market. First, I track the US dollar index, DXY. A stronger dollar tends to suppress gold and silver in the short term, while weakness can support prices. This is particularly relevant during oil shocks, when rising energy costs can simultaneously push the dollar higher. Second, I watch US Treasury yields, especially the 10-year note. Rising yields make non-yielding assets like gold less attractive, while falling yields reduce the short-term suppression mechanism. The interaction between Treasury yields and Fed policy is critical. Sustained high yields against a large debt load are not indefinitely sustainable, and any stabilization can trigger a rapid reversal in precious metals. Inflation data, CPI and PCE, also provide context. Higher than expected inflation reinforces the structural case for gold as a store of value, even if short-term prices remain suppressed. Industrial demand metrics are equally important for silver. Data on solar, EV, AI, and defense metals consumption highlights the underlying structural support, separate from short-term speculative moves. Volume, liquidity, and open interest offer insight into positioning. Sharp swings in gold or silver with low liquidity may exaggerate price moves, while sustained accumulation over weeks signals structural support. Central bank reports are another key indicator. In 2025, 863 tons of gold were purchased by central banks, a fact that doesn't affect intraday volatility, but indicates the underlying structural trend. Finally, I monitor commodity supply data, including COMEX inventories and global export restrictions. For silver, a 6-year supply deficit and restrictions on Chinese exports amplify the long-term bull case. These indicators together allow me to separate short-term noise from long-term structural signals. Watching them in real time is how professionals identify accumulation windows and potential market inflection points, rather than reacting to temporary spikes or pullbacks. The short-term fluctuations in gold, silver, and oil are easy to misread. A spike or pullback does not invalidate the structural thesis built over years of supply deficits, central bank accumulation, and macroeconomic dynamics. Understanding the difference between temporary market noise and long-term trends is critical for patient investors. Right now, March 2026, the market is showing exactly the conditions that historically precede sustained precious metals rallies. That doesn't mean immediate gains are guaranteed. It means the framework for a structural move is in place, and the short-term suppression mechanism will eventually reverse. Timing may be unpredictable, but the underlying forces are measurable and observable. This isn't investment advice. It's simply my interpretation of the market based on confirmed data and reputable forecasts. Discipline, patience, and risk management remain essential. Investors who focus on structural signals rather than emotional reactions to daily price swings are best positioned to navigate volatility and capture long-term opportunities.